To file single or to file jointly in 2025? Now that is the million-dollar question today. What's up, guys? Mike back at it again. Ledgerly CPA, along my business partner, Andrew D'Amico. He's got the mullet. It's flowing. Also a CPA, bringing you the latest and greatest tax strategies. Now, about a month ago, we're filming this in August, the One Big Beautiful Bill passed. A lot of people, a lot of friends, you know who you are watching this, have been asking me, Mike, we just got married. Do I file single? Do I file jointly? We don't know what to do. What's going on? Is it more beneficial? Yada, yada, yada. Don't worry. Don't fret. We're going to go through a nice listing of what it looks like to file single, what it looks like to file jointly in 2025. So let's hop right into it. All right, as we can see here, we have a nice little side-by-side comparison of what it's going to be looking like to file single or jointly in 2025 under some of the new deductions increases that have come along with President Trump's One Big Beautiful Bill. So right off the bat, if you're going to file single, your standard deduction has increased to $15,750. Now, if you're going to file jointly, your standard deduction is basically going to double. One for you, one for your spouse. Now, with some of the new increases that we're going to talk about in a second, it might make sense for you to start thinking about itemizing your deductions. Before the One Big Beautiful Bill, itemizing was pretty rare because of the SALT limitation, which we're going to talk about, interest rates as well, and some other things that come along with Schedule A deductions. Schedule A being itemized deductions. Okay, so that's if you're going to take the standard deduction. It's really 6 is 1/2 dozen with this. Now, if you're over the age of 65, you're going to get an additional $6,000 bonus. $6,000 for you, and $6,000 for you and your spouse. So a $12,000 max. However, there are modified adjusted gross income limitations here. If you're single, $75,000. If you're married, $150,000. Okay, here, 6 is 1/2 dozen, still the same. Now your tax rates and brackets, again, 6 is 1/2 dozen. If you're single, your rates are going to be 10 to 37%. And if you're married, it's going to be the exact same 10 to 37%, 37% being that cap. The child tax credit has now increased under the One Big Beautiful Bill to $2,200 per child. And that's going to be the same amount if you're married as well. See, if you can tell right now, we kind of have a trend of single and married are kind of neck and neck. It's essentially the same thing. Now, the SALT deduction, state and local tax deduction cap, has increased from $10,000 to $40,000. Now you might be saying, Mike, I have no clue what that means. And that's okay. We're going to go through a little case study right now. Now again, let's remember single, married filing jointly. The standard deduction for single for 2025 is $15,750 as we saw above. And for married filing jointly, it's $31,500. Now, if we go above the SALT deduction cap, we see that is increased to $40,000. However, there is a phase out, $500,000 in modified adjusted gross income. But let's use the same case study here. Let's compare apples to apples. Let's say you got Johnny here, and he's making $250,000. Now, Johnny has a home. He's a homeowner. There we go. Maybe a little picket fence around there. I can't draw. I'm an accountant. And let's say Johnny is paying $10,000 a year in state income tax on that $250,000. Let's say he's paying another $12,000 a year in real estate taxes on his home. And let's say he got the short end of the stick and he got his mortgage at one of the worst times and now he's locked in at an 8% rate. So let's say Johnny is paying $30,000 in interest on his home. Johnny has chalked himself up with $52,000 of itemized deductions. Now that's going to be freaking huge for Johnny. $52,000 of deduction over $15,000. That's an additional $37,000, people. That's massive. However, this is where we're going to bring it on home. Prior to the One Big Beautiful Bill passing, his taxes, his SALT, state and local taxes, was capped at $10,000. Now, if you remember, he had $10,000 in state income taxes and another $12,000 in property taxes. That's $22,000. Now, if we go back to the new bill, he's able to deduct up to $40,000. So he still has some wiggle room if he had some other property taxes on his vehicle, if he had any pass-through entity tax payments at a business level, discussion for another time. However, he's going to be able to take 100% advantage of that $22,000. Now, prior, Johnny would have only been capped at $10,000, which means he would have been SOL with this $12,000 that he paid, and he would have been capped at a $40,000 itemized deduction, losing out on another $12,000 of tax deduction. So 52 with one big, beautiful bill. The 40 would be without one big, beautiful bill. I don't know about you, but $12,000 per year, $1,000 per month, it's a pretty hefty tax deduction. Okay, cool. Now let's go to the married filing jointly side of the spectrum. I'm going to get rid of this over here, so we got some room. Boom, 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 boom. Love it. Okay, so married filing jointly. Now, let's say Johnny, put him back over here. Let's say Johnny meets a lovely lady named Jill. Let's give Jill some hair. Okay? Johnny and Jill, they get married. Here they are. Beautiful. Johnny and Jill now are going to double their income and they're going to make $500,000. And now let's say their state income tax doubled. Let's say they're now paying $20,000 in state income tax. Let's say the real estate taxes stayed the same. Let's say they moved into the same house together. And let's say the mortgage stayed the same at that 8%. They're still living in the same house together. Now, with the one big beautiful bill, they are looking at $62,000 of itemized deductions. Freaking massive compared to $31,000. Took a $30,000 increase in their tax deduction. Now, without the one big beautiful bill, you got it. They'd be capped at this 40 down here, which would be the $30,000 in the mortgage interest. And then they would be capped at 10 on the $20,000 in state income tax and the $12,000 in real estate tax. $40,000. So Johnny by himself down here would have lost out on $12,000. Gone. Would have lost out on it. And Johnny and Jill, there's Jill, long hair, love it, would have lost out on $22,000. Pretty freaking massive, people. Okay, so really important stuff here. SALT deduction cap. Very key. We're highlighting this in yellow because this might be the creme de la creme for this video, okay? Now, real quick, business owners, if you have a business, you still now have the qualified business deduction, which we had before, but now it's permanent. So what is that? In a nutshell, and this also applies to married individuals too. If you have $100,000 in net taxable income from your business, 20% of that is now a tax deduction. So $20,000 is now a tax deduction, meaning you're only going to pay tax on 80. Cool. Now the last two things for you individuals is the income tax deduction and exemption on tips and overtime, and also the auto loan interest. So for you individuals, for income tax purposes, not payroll tax purposes, tips and overtime, you can deduct up to $12,500, and for married individuals, that doubles to $25,000, with of course the income limitations and phase outs apply. And last but not least, the auto loan deduction. On new and qualified United States assembled vehicles, you might be entitled to an additional $10,000 auto interest deduction. The same deduction applies to you joint filers out there as well. Of course, again, with the income limitations. Okay, a lot of great stuff here, especially for you new joint filers who are newly married in 2025 or maybe in 2024 and are trying to navigate these brand new tax changes. Let's pump the brakes. Filing jointly is almost always more advantageous. You have a larger standard deduction. Number one, you have access to those combined credits, like the child tax credit. If you file separately and you're married, then only one of you is going to get that credit and the other one's not. The qualified business income deduction. If you or your spouse have a business, that 20% deduction is going to flow down to you together. If you don't file jointly, then one of you is going to lose out on it. Not to mention the solo 401k. More on that in another video. And also, probably the highlight of this video is the state and local tax, the SALT deduction. How that increased from $10,000 to $40,000 how we saw with Johnny and Jill. That can be a massive tax savings for you. Some other things to keep in consideration that we didn't talk about in this video, and mainly because they're not new, they've been existing, is the medical deduction. It's a losing formula. You need 7.5% of your adjusted gross income. If your adjusted gross income is $100,000, you need at least 7.5% of that, $7,500, and $1 for that $1 to be qualified as medical deduction. So what do we recommend? The HSA. Want more on the HSA? It's in the YouTube archive. The other thing too is charitable deductions and charitable contributions. If you're a charitable person, those deductions are still on the table as well. So to bring it on home, for all of you newly married couples out there, this is a frequently asked question for us and just in general in the industry for accountants to hear. Should I file single or should I file jointly? However, really important, let's take a big step back. Let's make sure that you and your spouse are on the same page financially. You know each other's income situations, your debt situations, because yes, it might make sense for you to file jointly, but when we peel back the onion even further, there might be some baggage that you two really do need to talk about. So let's make sure we're all on the same page. Let's understand our deductions. Let's understand our financial health and well-being. And if you want to bring everything to the table, we would really encourage you to book us for a comprehensive consult to peel back that onion and really get into the nitty-gritty of each of your financial picture, your past, your future, your present, your goals, your aspirations. And let's paint that picture in the trifecta. So for all you newlyweds, congrats. Soon to be newlyweds, congrats. Already married, congrats. Let's grasp on to our potential tax savings and tackle them together. We'll see you on the other side.